Coming up in this video, a live stream from stream.am/life insurance. We talk today about different uses of cash value in life insurance and answer your questions. Coming up now. Well, good morning, everybody. Again, this is the Life Insurance Rockstar, and I'm here with you this morning to answer your life insurance related questions, answer any questions you may have, give you some background and some information about all things life insurance. We could be talking about term insurance, whole life insurance, universal life insurance, pretty much anything you have questions on, I will hopefully have answers for. While we're waiting for some people to log in, just give you a little bit of information about myself. I've been in the insurance industry for over 25 years, and I've been specializing in life insurance the entire time as well. We have our stream channel, which you're watching right now, of course, and we also have a YouTube channel, which you can find at youtube.com/c/lifeinsurancerockstar. You can also find us on Twitter at LifeAgentRocks. And of course, Facebook at facebook.com/lifeinsurancerockstar. So, as I'm standing by here, I'm waiting for a few more people to join. I'll just give a quick shout out to all my friends out there that are watching. Quick shout out to everybody that's here. Appreciate you coming. Hopefully we'll have some fun this morning. You can see I came out to the ranch property just for a little change of scenery. And here I am. It is so far not too hot. It's about 70 degrees, probably going to be closer to 90 today, so it's a good time for me to be out here before it starts getting terribly hot. And now we've got a handful of folks in there. Anyone? All right, I'm just going to activate this one button here so I can see the questions coming in. It is beautiful. Thank you. I'm very blessed that I do have a place that I can go to sort of get away from the city. Our main office is in Los Angeles, which, as you can imagine, does not look like this. So I am happy to be able to have a place that I can get away when I need some time to gather my head. And maybe if you like later, if you guys like, I can take you for a little perimeter walk around, let you see what it looks like. It is very quiet. Actually, it was so quiet last night, I was actually having trouble sleeping. It sort of reminded me, you ever see My Cousin Vinny? Remember in that movie how he can't sleep because it's too quiet? And then once they throw him in jail and he's in prison and there's all the jail riots going on, all of a sudden it's all the noise and it reminds him of being in New York where he's from, and he falls asleep. Somehow I felt a little bit like that last night because it was so quiet here. And again, it's not as if Los Angeles is Manhattan, but there's noise. You know, you can hear cars, you can hear airplanes, there's just stuff. Out here at night, there was basically no sounds at all. It was just quiet. Right now, I think all I can hear is, let me see. Nothing. Last night we had some coyotes. They probably found some food, and all of a sudden you could hear them. It sounded like a frat party out here. They were just going crazy. Well, let me get started. Answer some basic questions for you about life insurance. One of the main questions that I'm asked very frequently is, do I get life insurance when I'm young, or do I wait and get it when I quote-unquote need it when I'm older? Actually, we were asked that on an earlier show, and my answer is very simple. Life insurance is priced based on your health and your age. That means the younger you are when you buy it, the less expensive it's going to be. Also, when you're younger, in theory, you're healthier than when you get older. I'm 42. I like to think I'm in decent shape, but I think I was probably still in better shape when I was in my 20s or 30s. Working on it, though. Working on it hard. But So the fortunate thing is that I did start purchasing life insurance when I was younger. So even if horrible things happen to me now and I gain a ton of weight and come down with any type of health condition, I would always be able to maintain those life insurance policies that I have at that super young, super preferred rate that I had then. Wow, did you see that shadow? That was a big hawk that just flew over my head. There's another one up there on the rooftop. If all of a sudden you see me get eaten, you'll know, you'll see it live right here on stream. So anyway, the idea with life insurance is you want to buy it when you're as young and as healthy as possible. Now, the problem is that when we're young, we feel like, what the hell do we need it for? Why do we need life insurance? We're, in our 20s, maybe even our 30s. Yeah, I'll get that someday when I'm married or I have kids or I have a mortgage or blah, 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 blah. And then, of course, it's more expensive or you're too sick to qualify for it. So the trick is, if you're going to spend money on life insurance at that particular at a young age, you want to make sure that you're buying something that's actually going to have an investment component to it, right? You want to be able to know that if you're writing checks when you're in your 20s and 30s for life insurance, when you don't feel like you quote unquote need it that badly, at least know that that's actually creating a nest egg for you as well. Uh, how did I find Stream for life insurance? I'm being asked. Well, I was, yeah, thanks, Dan. It is, I think before I'm done, I'll go for a little walk and let everyone have a look. If these big crows don't eat me first. But to answer the question there, I was asked, how did I find Stream for life insurance? I've always sort of been trying to find a way to get the message out and get some of the information and some of the experience that I have about life insurance, out to potential clients. And I've tried everything, all the typical stuff, email, blog posts, mailers, things like that, SEO on our different web pages, and all of that works fine. But what I realized was to be able to actually reach out and talk directly to potential clients or really to talk to anybody was very powerful. And now that I have an application, and then I realized that, hey, if I could find an app that would allow me to basically just jump right in and communicate with people instantly, hey, that'd be pretty cool. I found Stream and I realized that, wow, pretty much anytime, day or night, if I am so inclined, I can just jump in the app, send out a tweet to people that are following me at Life Agent Rocks, throw a quick post on our Facebook page at facebook.com/lifeinsurancerockstar, and then boom, here I am talking. And I've got a dozen plus people that are coming in asking questions or learning about life insurance, or at least knowing that now they've got someone in the industry that's knowledgeable and available if they have questions. So Stream has been great for me so far. I've actually had a handful of streams that I've done actually in the car during commute time, which is normally fairly dead time. But I found that I can actually make pretty good use of that time growing the business and getting the word out and talking to people by just hooking up the camera in a place that is facing me and starting a stream. The only problem I have is when I'm driving, it's sometimes difficult to be able to see the questions that are coming up on the screen. But other than that, it's terrific. I get a chance to just do a little bit of monologuing and talk about some key concepts about life insurance. And the response has been terrific. I hear an airplane. Wow. Big change to the quiet all of a sudden. Any other questions before I jump back into my soliloquy about life insurance for this morning? Okay, question is asking that somebody, and I will never say names. I suppose everybody can see it, but some of these recordings are kept, and the video part is, and not the chat. So for privacy issues, just so you know, I'll never be saying your name. I'll just be referencing your question. Question is being asked that somebody has ESKD and they're waiting for a kidney. Should they get life insurance now or should they wait? And I'll answer you. Getting kidney transplants is not as dangerous as it used to be. The most difficult part is in the waiting, is in waiting to actually get the match. Obviously, you get on the list. You mentioned that you don't have a kin, that next of kin that you can get a kidney from, so you're more than likely on a pretty long waiting list. What you want to do is you would need to get a specific type of life insurance company that deals with people that have health conditions. You're not uninsurable by any stretch of the imagination. You would probably pay slightly elevated premium to, compared to someone that has 2 functioning kidneys that's not planning on having a transplant. But you absolutely should start looking right away now, get the application submitted. And again, there are certain companies that specifically work with people. For example, I had a client that was, funny guy. He had bypass surgery many years ago, and he was supposed to have a stent put in, and he was putting it off. Go figure, right? I mean, for those of you who don't know, a stent is basically when they go into the arteries that lead to the heart, and they pry it open with a tiny piece of plastic of some kind, and it opens the vein up. So he's putting this off. Go figure. It's going to save his life, but he's putting it off. And he called me and he said, yeah, I'm thinking about going and getting this done finally. I want to up my life insurance. Well, that's perfectly reasonable, obviously. And one of the things I had to explain to him was since you are, you've been told to have surgery or a procedure that you have not yet had, we're going to have to go to a special company so that we can disclose that and let them know. And what they ended up doing was they did what's called a rated policy, where they gave us the policy that we wanted, and they charged an elevated premium for a period of time. And once that period of time was over, in this case it was 2 years, the premium went back to the standard rate that he would normally qualify for. So again, you need to be able to find the right carrier, because some companies would look at that and say, huh, "You're waiting for a kidney? Yeah, okay. Let's talk once you've got the kidney, and you're fine for 2 or 3 years." But in this particular case, no. There's always an insurance company willing to take the risk. And again, you're thinking, "Oh my God, what's the price going to be?" It's not about that. You can always find a carrier that will give you an offer. Once you have an offer, then you can begin the negotiation with them about the price. Also, what a lot of times happens is you might get one insurance company that says, "All right, we're willing to write the insurance for you, but we're going to turn around and give you a higher rate." Then what the independent agents will do, at least what I do, is I'll turn around and go to that insurance company and say, "All right, well, since you're willing to do it for that price, I'm going to check around with 3 or 4 other carriers, see if they can do better, because the client wants to get the insurance." And you can guess what happens. Now I've got multiple insurance companies that are bidding, quote unquote, against each other. Sometimes even when there's not another insurance company, I'll make that claim to them because I want to get the best price I can for the client, right? Yeah, they can do rate drops. They can do rate increases. What they can do is they can give what's called a rated policy, which basically means that they're going to charge a higher rate, and they can call it a flat extra or a table rating. Insurance companies love jargon. All that it boils down to is they say, "All right, we're going to charge you the standard rate plus 10% for 2 years. And after that, it drops down. Or we're going to charge you the standard rate plus 300%. And after that, a period of 4 years, it'll drop down." It's contractual. It's in the policy. It's in your actual policy. So it's not as if that person that made that decision is gone, they won't do it, or it's an if, and, or but. It's actually contractually bound that way. I'll give you another example. I wrote a policy a week or two ago on a couple. They were both living with HIV. And they, of course, thought they could not get life insurance, and actually they can. So I wrote 2 nice-sized $100,000 policies, one for each of them. And the way it worked for them is the insurance company, because of the time period that it had been since they had been diagnosed, was relatively short. They gave an increase of premium of about 40%, I think it was. But a 40% increase for the next 48 months. After that increase, that elevated premium goes away. Basically, they're hedging their bets. They're saying, "Well, we're going to do it, but because you've been diagnosed so recently, we're going to charge a little bit more money for a period of time, and then we'll take you back down to the rate that we're comfortable with based on your individual exposure." And that's done all the time. There's actually some insurance companies that specialize. It's called table shaving. Isn't that great? All these funky terms. Table shaving means they'll say, "Well, you bring us the best rating you have, and we'll take off one rating and make it that much less expensive." As competitive as the life insurance industry is, and you go online, you search life insurance, and it's, you've got 1 million people out there and 1 million companies and 1 million web pages. As competitive as that is, believe it or not, the insurance companies themselves do have to compete with each other. They can't do that if they don't know that there's another bid going on. And that's one of the reasons that I love dealing with so many carriers. I write on average with about 30 different insurance companies regularly, and there's another 40 or 50 that I sort of keep in the wings on the fringe for policies that are very specific that I need to work with. But in general, it's rare that I'll write a policy where I'm not submitting it to multiple carriers at the same time to try and come back with the best rate. And what'll happen most of the time is if it's a preferred rate and they're all giving us a preferred rate, then I have to look to see which policy is going to give us better provisions. Believe it or not, all policies are not created equal, far from it. Questions coming in. How do I feel about paying for a small policy premium with dividends from the policy versus paying out of pocket for the premium? It's a great question. Just a little background. What he's talking about is permanent life insurance. Typically, there are whole life policies that will offer dividends. And a dividend is basically a return on the premium that you're paying. A percentage of the premium is getting interest and getting dividends, so it's growing. So let's say you're paying $1,000 a year, maybe $500 of that is going into a savings account that's yours, and they're paying you interest or dividends on that. What the question is saying is, what do I think it's better to do? To use that money to pay for the premium, which a lot of people will do. They'll say, "Well, I've had the policy for 10 years. I have X number of dollars in cash. I'm just going to stop paying for premium, and I'm going to let this cash value that's in the policy pay for the premium. Plenty of people do that, and it's a very good philosophy. It works very well. The only downside to that is now you're eating into the cash value that you have. So if people were going to turn around and say, I'm buying life insurance and I want to make sure that I'm also keeping a savings, there's also an investment component, they're eating up the savings component at the same time. So you need to be careful about deciding if you're going to do that, what's your goal? Is your goal actually that you're going to have a savings growth of some type of an investment or savings in your life insurance? Or did you just want to pay as little as possible, period? In which case, if you wanted to pay as little as possible, you could calculate when your cash value is actually going to increase more than the premium is. And at that point, you could start using that premium, the cash value, to pay the premium. So you can do it either way. Again, it just depends on what your goals are. They're both perfectly reasonable as long as you know what you're doing. And the other nice thing about that is once you pull the trigger on that, maybe that's a bad metaphor for this, but once you pull the trigger on that, it doesn't mean you're stuck doing that forever. You might decide just to use the cash value to pay for your policy for a few years. Maybe you just have a rough patch and you just don't have the cash to lay out for it. No problem. You can take the cash, pay for the premium, and then start paying for it again, and you'll be able to refill that bucket of cash that you borrowed to pay the premium before. Another question. Quote $1,000. What's the payout at death? Oh, absolutely. It's flexible. You're not locked into any of those issues. Not with a decent policy anyway. Flexibility is definitely the name of the game. And the type of policy you mentioned with dividends and cash value, that's the point, is that you've got flexibility to do different things like that. Back to this other person, you were asking for a $1,000 policy. What was the death benefit? Was that the question? I'm just trying to understand. It was scrolling by pretty fast. If that was the question, the $1,000 in the $100,000 policy that I was talking about a few minutes ago, there were two that I wrote for a couple that were both living with HIV. And each policy was, one policy was I think $1,200 a year, and the other one was I think $1,500 a year. Just random there, but if you're trying to sort of get an idea of what are people paying for life insurance if they're living with HIV, it depends on their age, it depends on when they were diagnosed, it depends on, believe it or not, sometimes what state they're in. Some states offer policies that other companies that aren't offered in every state. State regulations are different. So, for example, New York and California are actually typically the more complicated states. You might have a policy available in every state but New York and California, and you can get a similar policy or the same policy with a different name in those two states. Any other questions out there? Appreciate all the thumbs up. That's always nice to see. You bet. And of course, if you have other questions, you can feel free to contact me offline. Just hit the webpage at lifeinsurance.rocks, and I'll be happy to get back to you individually. We also have a 24-hour phone/text line that you can call or text questions to, 310-817-2704 at your leisure. Happy to take those calls or questions. And again, we are HIPAA compliant. Everything is extremely confidential, and happy to answer any questions you have. I'm going to give my voice a little break here, and I will give you a little background, literally, of what's going on back here, so you can see. Woo, sunny. So this is behind the ranch property here, and I'll just give you a quick view of what's back here. If you look back there, can you see the? Yep, there you go. Back there, you see some haystacks, and the haystacks we've got over there is the kids like to try and shoot bow and arrow. So we've got a bow and arrow with a bunch of arrows, and they will stand, let's see, they'll stand right about there where you see that bench, and they'll shoot all the way over to those stacks of hay. Usually they'll hit the target, sort of. It's snowing in Arkansas right now. Wow, I'm born and raised in California, so I know I'm spoiled. There's no question about it. I lived in Portland, Oregon for a few years, so I do know what cold and rain and wet is like, but not like Arkansas. My hat's off to you. But I have to tell you, what is it now? The end of March? Really? This is the weather in March? Whatever. I mean, really? We didn't really have a winter in California this year. It was crazy. Really crazy. Any other questions out there before I jump back in and just sort of start yapping at you? Feel like saying, Bueller, Bueller. Whew, I get bit by a mosquito. What's that all about? Actually, one thing I need to be careful of right now, since it's already warm out, are rattlesnakes. There are rattlesnakes out here. I need to be careful of that. Let me talk a little bit more about the flexibility of certain life insurance policies. One of the people watching asked about using the cash value dividends or interest to actually pay for a life insurance policy. Let me explain in general how that works. Let's say you buy a policy when you're 30 and you're paying $1,000 a year, right? Always simple round numbers. And of that, let's say $700 of that is going into cash. $300 of that is actually paying for the premium. It's paying for the insurance company's actuarial risk that you're going to die prematurely, right? So you've got that $700 that's going into the cash value. Mind you, you're not aware of any of this per se. You're not deciding, I want to put this much here and that much there. Side note, there are policies that will let you decide how your cash value is invested. You can actually pick out mutual funds to invest the cash value in, which is pretty amazing. That's a whole other issue. So you're paying premium, you're getting cash value, you have death, and you have the life insurance as well. So now, you fast forward 10 years and you've got, 30, 40 grand in cash. And what does that mean in cash value? What does all that mean? Okay, here's how it works. The life insurance carriers are not stupid. They know that everyone's ideal in the world would be, just give me a level premium for my entire life. I don't care about cash. Basically, I want a lifetime term, right? Who would like just a lifetime term? Anyone want one of those? Just give me a thumbs up, because that's what everyone always initially says. They say, just give me a level premium for my entire life. I don't care about cash. I don't care about any of the fancy investment. I just want life insurance with one premium and one death benefit for my entire life, and that's the end of that. Believe it or not, it does exist. It's not called term insurance. They're called guaranteed universal life policies. But make a long story short, so the life insurance company said, well, we're not making a lot of money on that idea. We want to get more dollars out of people, right? So they came up with a concept of, well, we can only charge them so much money for life insurance because there's competition, right? So let's come up with a way to get more money out of them by saying, pay us more money than we need just to cover you for life insurance, and we'll give you these special investment tools, so that the money you're giving us over and above what we need to pay for your actual life insurance will be yours, and it'll earn interest it'll earn dividends, and you'll be able to decide what to do with that money. It's pretty cool. There are actually IRS regulations that dictate how much cash you can put into a life insurance policy compared to what the premium is that you're paying, which is actually interesting. People will buy policies probably almost as often as they're buying it for life insurance. They're buying it for the tax shelter. They're buying it for the ability to be able to take that money and put it into savings and earn interest on a tax-deferred basis. That's actually an interesting point I should probably mention. Did you know, fun fact, that the cash that the interest in the dividends that you're earning in your cash portion, right? This is the part of the account that has your cash in it, is actually growing every year, and it's not taxing you. It's tax deferred. If you had money in a mutual fund or money in a savings account or money anywhere and it was earning interest every year, you would pay taxes on it. That same growth that's happening within a life insurance policy, you are not taxed on every single year. That's pretty cool, right? So people shove tons of money in there because they want to be able to have the tax-free growth. So what's the catch? It's always a catch, right? Well, what happens is when the time comes and you decide to take that money out, there's something called first in, first out, which is a terrific concept. The insurance companies and the IRS have this arrangement where when you take money out of a life insurance policy, your cash value, the first dollar you take out, they will assume is the first dollar you put in, which is your premium. So it's considered a return of premium. You're not taxed on that. So if over 30 years, let's say you've got $50,000 in cash, and of the $50,000 in cash, your contribution to that was, let's say, $30,000. You can go and take out $30,000 from that life insurance policy and not pay a penny of taxes because it's considered a return of your premium. The only time you would have any type of a taxable event would be for the money that's over and above the premium you put in. So you've got free access to your own money without any type of tax ramifications. And when you start taking out money in excess of that, then you're paid the long-term gain just like you would on any other type of an investment. The theory is that you're doing that in retirement, you're in a lower tax bracket, or in reality you have found more loopholes, things like that are going on. So going on 25 minutes, which is normally about the mark that I try and shoot for on these. So are there any questions out there before I sign off for right now? I'm actually going to be going back inside. We're shooting some film for the YouTube channel. So you'll be able to know next time you're watching the YouTube channel that you were just seeing me live right before I was shooting some of those videos. Again, if you have any questions, feel free to visit me at lifeinsurance.rocks. Check out our YouTube channel. It's youtube.com/c/lifeinsurancerockstar. Love to have you subscribe there. Follow me on Twitter. It is actually me on Twitter. And I will see you guys probably in a couple of hours when I'll take a break from that to come out here again.
Brought to you by the Life Insurance Rockstar at www.lifeinsurance.rocks.